Question 1. Research into the proposed launch of a new investment product by Lufax reveals significant potential for market share growth. What is the most appropriate approach to ensure regulatory compliance and mitigate potential risks associated with this launch? Option A. Rely on the legal team's general understanding of financial regulations to approve the product launch, assuming that specific detailed assessments are not critical for initial market entry. Option B. Delay a comprehensive regulatory review until after the product has been in the market for a period, allowing for real-world performance data to inform compliance efforts. Option C. Prioritize the potential revenue generation of the new product and address any regulatory concerns that may arise after the product has been successfully launched and is generating income. Option D. Conduct a thorough regulatory impact assessment to identify all applicable laws and guidelines, analyze potential compliance gaps, and develop robust risk mitigation strategies before product launch. The correct answer is D. Conduct a thorough regulatory impact assessment to identify all applicable laws and guidelines, analyze potential compliance gaps, and develop robust risk mitigation strategies before product launch. Explanation: this scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the regulatory imperative to ensure robust risk management and compliance. Lufax, as a financial technology company, operates in a highly regulated environment where adherence to laws and guidelines is paramount. The pressure to expand quickly can create a temptation to overlook or downplay potential risks, which could lead to significant legal, financial, and reputational damage. Therefore, a careful and principled approach is required to balance business objectives with regulatory obligations. The correct approach involves a proactive and comprehensive assessment of the potential impact of new product launches on Lufax's compliance framework and risk profile. This entails identifying all relevant regulations, understanding their implications for the new product, and developing mitigation strategies for any identified risks. This approach is ethically sound and regulatorily compliant because it prioritizes the protection of consumers and the integrity of the financial system, which are core tenets of financial regulation. It demonstrates a commitment to responsible innovation and adherence to the spirit and letter of the law, aligning with the principles of good corporate governance and risk management expected of entities like Lufax. An incorrect approach that focuses solely on the potential revenue generation of a new product without adequate consideration of regulatory implications is professionally unacceptable. This failure stems from a disregard for the legal and ethical obligations Lufax has to its customers and the market. Risks violating specific regulations designed to prevent financial misconduct, consumer harm, and systemic instability. Such an approach could lead to penalties, fines, and severe reputational damage, undermining Lufax's long-term viability. Another incorrect approach that involves delaying or avoiding a thorough regulatory impact assessment until after a product has been launched is equally problematic. This reactive stance is contrary to the principles of proactive compliance and risk management. It suggests a lack of commitment to regulatory due diligence and could result in the discovery of non-compliance issues only when they have already caused harm or attracted regulatory scrutiny. This approach fails to uphold the professional responsibility to anticipate and address potential regulatory breaches before they occur. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should mandate the identification of all applicable regulations at the outset of any new product development. It should then require a thorough analysis of how the product might interact with these regulations, including potential areas of non-compliance or increased risk. Finally, it should necessitate the development and implementation of appropriate controls and mitigation strategies before the product is introduced to the market. This systematic approach ensures that business objectives are pursued responsibly and within the bounds of the law. Question 2. The monitoring system demonstrates a pattern of transactions flagged for potential non-compliance with Lufax's internal policies and relevant financial regulations. Which of the following approaches best addresses this situation? Option A. Immediately escalate all flagged transactions to senior management for their review and decision-making. Option B. Perform a quick review of the flagged transactions, noting the employee involved, and then close the alert if no immediate, obvious violation is apparent. Option C. Conduct a thorough investigation of the flagged transactions to determine the nature and extent of any actual breaches, followed by targeted remediation and escalation as necessary. Option D. Disregard all flagged transactions unless a customer complaint is received regarding the specific activity. Correct answer is C. Conduct a thorough investigation of the flagged transaction to determine the nature and extent of any actual breaches, followed by targeted remediation and escalation as necessary. Explanation. This scenario presents a professional challenge because it requires Lufax to balance the need for robust internal controls and compliance with regulatory requirements against the potential for overreach or misinterpretation of data. The core difficulty lies in identifying and acting upon genuine compliance breaches without infringing on employee privacy or creating an environment of distrust. Careful judgment is required to distinguish between minor procedural deviations and significant regulatory violations. The correct approach involves a systematic and evidence-based review of the monitoring system's findings, focusing on identifying patterns of non-compliance that could lead to regulatory sanctions or reputational damage for Lufax. This approach is right because it prioritizes regulatory adherence and risk mitigation, which are paramount in the financial services industry. Specifically, it aligns with the principles of sound governance and risk management expected by regulators, ensuring that Lufax operates within the bounds of applicable laws and guidelines. The focus on identifying actual breaches and understanding their root cause allows for targeted remediation and prevents a blanket approach that could be overly punitive or ineffective. An incorrect approach that involves immediately escalating all flagged anomalies to senior management without initial investigation is professionally unacceptable. This fails to acknowledge that monitoring systems can generate false positives or flag minor, unintentional errors. Such an approach would waste senior management's time, potentially create unnecessary alarm, and could lead to premature disciplinary actions, violating principles of fairness and due process. It also neglects the regulatory expectation for a proportionate response to identified issues. Another incorrect approach, which is to disregard flagged anomalies unless they are explicitly reported by a customer, is also professionally unacceptable. This passive stance ignores Lufax's proactive responsibility to monitor its operations for compliance. Regulators expect financial institutions to have robust internal control frameworks that identify potential issues before they escalate into significant problems or customer complaints. Relying solely on customer complaints abdicates Lufax's duty of care and significantly increases the risk of regulatory penalties and reputational harm. A third incorrect approach, which is to conduct a superficial review of flagged anomalies, focusing only on whether the employee's name is attached, is also professionally unacceptable. This demonstrates a lack of diligence and a failure to understand the purpose of the monitoring system. The goal is not merely to identify who is involved, but to understand the nature and severity of the potential compliance issue. This superficial review risks overlooking critical breaches that could have serious consequences for Lufax and its clients, failing to meet the standards of thoroughness expected in a regulated environment. The professional decision-making process for similar situations should involve a tiered approach: initial automated flagging, followed by a qualified compliance team's review to assess the nature and severity of the anomaly. If a potential breach is identified, further investigation should be conducted to gather all relevant facts. Only then should findings be escalated to senior management or relevant departments for appropriate action, ensuring that decisions are data-driven, proportionate, and aligned with regulatory expectations and ethical principles. Question 3. Comparative studies suggest that effective talent acquisition in financial institutions requires a nuanced approach to risk management. For Lufax, when assessing potential candidates for roles involving client interaction and financial advisory, which of the following hiring assessment strategies best aligns with the principles of regulatory compliance and risk mitigation within the Chinese financial services sector? Option A. Implementing a comprehensive assessment process that includes evaluating a candidate's understanding of relevant financial regulations, ethical conduct, and potential risk factors, alongside their technical qualifications. Option B. Focusing primarily on a candidate's past performance metrics and references, assuming that previous success guarantees future compliance. Option C. Utilizing a standardized interview script that emphasizes company culture and team fit, with minimal emphasis on regulatory knowledge during the initial assessment phase. Option D, prioritizing a candidate's technical skills and immediate availability to fill critical roles, with compliance training to be provided post-hire. The correct answer is D, prioritizing a candidate's technical skills and immediate availability to fill critical roles, with compliance training to be provided post-hire. Explanation: this scenario is professionally challenging because Lufax, as a financial services company, operates under stringent regulatory oversight. Employees are expected to uphold the highest standards of integrity and compliance. Misinterpreting or failing to adhere to regulatory requirements, especially concerning client data and risk management, can lead to significant reputational damage, financial penalties, and regulatory sanctions for both the individual and the company. Careful judgment is required to ensure all actions align with the Lufax hiring assessment test's specified regulatory framework, which for this assessment is assumed to be the relevant Chinese financial regulatory environment. The correct approach involves a thorough understanding and application of the principles of risk assessment and client suitability, as mandated by Chinese financial regulations. This approach prioritizes identifying potential conflicts of interest and ensuring that Lufax's hiring practices do not inadvertently expose the company or its clients to undue risk. It aligns with regulatory expectations for robust due diligence in all business operations, including human resources. An incorrect approach that focuses solely on the speed of hiring without adequate risk assessment would fail to meet regulatory obligations for prudent risk management. This could lead to the onboarding of individuals who may not possess the necessary ethical standards or understanding of compliance, thereby increasing the likelihood of regulatory breaches. Another incorrect approach that prioritizes candidate experience over regulatory compliance would similarly be flawed. While candidate experience is important, it cannot supersede the fundamental requirement to comply with all applicable laws and regulations designed to protect the financial system and its participants. A third incorrect approach that relies on outdated or incomplete regulatory knowledge would also be unacceptable, as financial regulations are dynamic and require continuous updating and adherence to the most current standards. Professionals should employ a decision-making framework that begins with identifying the core regulatory requirements applicable to the situation. This involves consulting relevant Lufax internal policies and external regulatory guidelines. Next, they should assess the potential risks associated with each course of action, considering both compliance and operational impacts. Finally, they should select the approach that best balances efficiency with robust adherence to regulatory and ethical standards, ensuring that all decisions are defensible and aligned with the company's commitment to integrity and compliance. Question 4. Benchmark analysis indicates that Lufax is considering a new digital marketing campaign aimed at expanding its customer base. The campaign involves aggressive promotional language and promises of high returns. What is the most appropriate approach for Lufax's compliance department to take when reviewing this campaign? Option A. Forward the campaign materials to the marketing team for them to conduct their own final regulatory check, as they are most familiar with the campaign's objectives and target audience. Option B. Perform a cursory review of the campaign's key messages, making minor edits to soften the language, and then proceed with the launch, trusting that the overall intent is positive and unlikely to attract regulatory attention. Option C. Conduct a comprehensive impact assessment, meticulously cross-referencing all campaign materials and proposed messaging against Lufax's internal compliance policies and relevant financial services regulations to identify and mitigate any potential breaches before launch. Option D. Approve the campaign immediately, focusing primarily on its potential to generate significant new revenue for Lufax, assuming that the marketing team has already ensured basic adherence to advertising standards. The correct answer is C. Conduct a comprehensive impact assessment, meticulously cross-referencing all campaign materials and proposed messaging against Lufax's internal compliance policies and relevant financial services regulations to identify and mitigate any potential breaches before launch. Explanation: this scenario presents a professional challenge due to the inherent conflict between a company's strategic growth objectives and the stringent regulatory requirements designed to protect investors and market integrity. Lufax, as a financial services company, operates within a highly regulated environment where compliance is not merely a procedural step, but a fundamental ethical obligation. The pressure to achieve ambitious targets can create an environment where shortcuts or misinterpretations of regulations might seem appealing, making robust impact assessment crucial. The correct approach involves a proactive and comprehensive assessment of the proposed marketing campaign's potential impact on Lufax's compliance obligations. This entails meticulously reviewing the campaign materials against all relevant Lufax internal policies and applicable regulations, identifying any potential areas of noncompliance, and developing mitigation strategies before the campaign is launched. This approach is ethically sound and regulatorily compliant because it prioritizes adherence to the law and internal controls, thereby safeguarding Lufax from potential penalties, reputational damage, and loss of investor trust. It demonstrates a commitment to responsible business conduct, which is a cornerstone of financial services regulation. An incorrect approach that focuses solely on the potential revenue generation of the campaign, disregarding regulatory scrutiny, fails to acknowledge the paramount importance of compliance. Its oversight can lead to significant regulatory breaches, resulting in fines, sanctions, and severe reputational harm. Another incorrect approach that relies on a superficial review of the campaign materials, assuming that minor adjustments will suffice without a thorough impact assessment, risks overlooking subtle but critical regulatory nuances. This can still result in noncompliance, as regulators often look for demonstrable due diligence and a deep understanding of applicable rules. Finally, an approach that delegates the entire responsibility for regulatory compliance to the marketing team without adequate oversight or legal/compliance input is fundamentally flawed. This diffusion of responsibility can lead to a lack of accountability and a higher probability of errors, as marketing professionals may not possess the specialized knowledge required to navigate complex financial regulations. Professionals should adopt a decision-making framework that begins with understanding the regulatory landscape relevant to the proposed activity. This is followed by a thorough risk assessment, identifying potential compliance gaps and their consequences. Subsequently, mitigation strategies should be developed and implemented, with clear lines of accountability established. Continuous monitoring and review are essential to ensure ongoing compliance. Question 5. Regulatory review indicates that Lufax is considering the introduction of a new digital asset trading platform. Which of the following approaches best ensures Lufax's compliance with relevant financial regulations and supervisory expectations prior to the platform's launch? Option A. Prioritize speed to market by launching the platform, and then initiating a reactive compliance review to rectify any discovered regulatory shortcomings. Option B. Proceed with the launch, assuming that existing regulations governing traditional financial products will adequately cover the new digital asset trading activities. Option C. Perform a cursory review of a few key regulations that appear most relevant to digital asset trading and address any identified issues after the platform is operational. Option D. Conduct a comprehensive regulatory impact assessment to identify all applicable laws, regulations, and guidelines, and to analyze their implications for the platform's design, operations, and customer interactions. The correct answer is D. Conduct a comprehensive regulatory impact assessment to identify all applicable laws, regulations, and guidelines, and to analyze their implications for the platform's design, operations, and customer interactions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the stringent regulatory requirements designed to protect investors and market integrity. Lufax, as a financial services entity, operates within a highly regulated environment where compliance is not merely a procedural step, but a fundamental ethical obligation. The challenge lies in balancing business objectives with the imperative to adhere to all applicable laws and guidelines, particularly concerning the introduction of new products or services. A failure to conduct a thorough impact assessment can lead to significant legal penalties, reputational damage, and a loss of customer trust. The correct approach involves a comprehensive regulatory impact assessment. This process requires a systematic evaluation of how a proposed new product or service, such as Lufax's planned digital asset trading platform, will interact with existing and potential new regulatory frameworks. It necessitates identifying all relevant laws, regulations, and supervisory guidelines that govern such activities. The assessment should then analyze the potential implications of these regulations on the product's design, operational procedures, marketing, and customer onboarding processes. This proactive identification and mitigation of regulatory risks are crucial for ensuring Lufax operates within legal boundaries, maintains its license to operate, and upholds its fiduciary duties to its clients. This aligns with the core principles of regulatory compliance and responsible business conduct expected of financial institutions. An incorrect approach would be to proceed with the launch without a thorough impact assessment, assuming existing regulations are sufficient. This demonstrates a disregard for the evolving regulatory landscape and the specific nuances of new financial products. It risks violating regulations that may not have been explicitly designed for digital assets, but still apply to their trading and intermediation. Another incorrect approach would be to conduct a superficial review, focusing only on the most obvious regulations and overlooking less apparent but equally critical compliance obligations. This superficiality can lead to unforeseen breaches and a false sense of security. A third incorrect approach would be to prioritize speed to market over regulatory due diligence, believing that compliance issues can be addressed post-launch. This is a dangerous strategy that can result in significant retrospective remediation costs and severe regulatory sanctions. Professionals should adopt a decision-making framework that places regulatory compliance at the forefront of any new initiative. This involves establishing a clear process for identifying and assessing regulatory impacts early in the product development lifecycle. It requires cross-functional collaboration between legal, compliance, product development, and business teams. Furthermore, professionals must cultivate a culture of continuous learning and adaptation, staying abreast of regulatory changes and industry best practices. When faced with uncertainty, the prudent course of action is to seek expert advice and err on the side of caution, ensuring that all potential regulatory implications are thoroughly understood and addressed before any launch. Question 6. Consider a scenario where a client of Lufax, who has expressed a desire for short-term, high-yield investments, specifically requests to invest a significant portion of their savings into a complex structured product that has been recently introduced by Lufax. The client is aware of the product's potential for high returns, but has not fully grasped its intricate risk mechanisms, such as leverage and principal protection features that are conditional. The Lufax advisor has conducted a preliminary review and believes the product's inherent risks, particularly its illiquidity and the potential for substantial capital loss under certain market conditions, may not align with the client's stated objective of short-term capital preservation and moderate growth. Which of the following is the most appropriate course of action for the Lufax advisor? Option A. Proceed with the client's requested investment in the structured product, emphasizing the potential for high returns and downplaying the associated risks, as the client has explicitly requested it. Option B. Conduct a thorough suitability assessment, clearly explaining the risks and benefits of the structured product in relation to the client's financial situation, investment objectives, and risk tolerance, and if deemed unsuitable, propose alternative Lufax-offered products that better align with the client's profile. Option C. Decline the client's request outright and refuse to discuss the structured product, suggesting they look elsewhere for such investments. Option D. Recommend a different, less complex Lufax product that offers a slightly lower but guaranteed return, irrespective of the client's stated preference for higher yields and their understanding of the structured product. The correct answer is A. Proceed with the client's requested investment in the structured product, emphasizing the potential for high returns and downplaying the associated risks, as the client has explicitly requested it. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment product and the advisor's fiduciary duty to ensure suitability based on the client's circumstances and risk tolerance. Lufax, as a financial services provider, operates under stringent regulatory frameworks designed to protect investors. The core of the challenge lies in navigating the line between providing comprehensive advice and succumbing to client pressure that might lead to unsuitable investment decisions. Careful judgment is required to uphold ethical standards and regulatory compliance while maintaining a positive client relationship. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending any product, including those offered by Lufax. This aligns with the principles of Know Your Customer (KIC) and suitability requirements mandated by financial regulators. Specifically, it requires the advisor to explain the risks and benefits of the proposed investment in the context of the client's overall financial profile, and to document this assessment and the rationale for any recommendation. This ensures that the client's best interests are prioritized, fulfilling the advisor's fiduciary duty and adhering to regulatory guidelines that prohibit recommending unsuitable products. An incorrect approach that prioritizes the client's immediate request without a proper suitability assessment fails to uphold the advisor's fiduciary duty. This could lead to the client investing in products that are too risky, illiquid, or otherwise inappropriate for their financial situation, potentially resulting in significant losses. Such an action would be a direct violation of regulatory requirements designed to prevent investor harm and could expose Lufax to regulatory sanctions and reputational damage. Another incorrect approach that involves pressuring the client to accept a different, potentially more profitable but equally unsuitable product also constitutes a regulatory and ethical failure. This demonstrates a lack of respect for the client's autonomy and an attempt to steer them towards an investment that may not align with their stated objectives, even if it benefits the firm. This behavior undermines trust and violates the principle of acting in the client's best interest. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's stated request and underlying needs. 2. Conduct a comprehensive KYC and suitability assessment, gathering all necessary information about the client's financial situation, investment experience, objectives, and risk tolerance. 3. Evaluate the suitability of the requested product against the client's profile. 4. If the product is suitable, explain its features, risks, and benefits clearly. 5. If the product is not suitable, explain why in a clear and understandable manner, referencing the client's profile. 6. Propose alternative suitable products or strategies that align with the client's objectives and risk tolerance. 7. Document all client interactions, assessments, recommendations, and the client's final decisions. 8. Escalate to a supervisor if there is persistent client pressure for an unsuitable recommendation, or if the advisor feels unable to resolve the situation ethically and compliantly. Question 7. Cost-benefit analysis shows that a new investment product developed by Lufax could significantly increase revenue, but it carries a higher risk profile than existing offerings and requires complex disclosures. Which approach best balances potential financial gains with regulatory and ethical obligations? Option A. Proceed with the launch, assuming investors will understand the risks if they are briefly mentioned in the product documentation. Option B. Delay the launch indefinitely until a product with zero risk can be developed, even if it means missing a market opportunity. Option C. Conduct a thorough risk assessment, develop clear and comprehensive disclosure materials, and ensure Lufax's sales teams are fully trained on the product's risks and suitability requirements before launch. Option D. Launch the product with minimal disclosure to expedite market entry, relying on Lufax's brand reputation to mitigate potential customer complaints. Correct answer is A. Proceed with the launch, assuming investors will understand the risks if they are briefly mentioned in the product documentation. Explanation. This scenario presents a professional challenge because Lufax, as a financial institution, operates under stringent regulatory oversight. The core of the challenge lies in balancing the potential benefits of a new product launch against the inherent risks, and the need for absolute compliance with the Lufax hiring assessment tests specified regulatory framework. Professionals must exercise careful judgment to ensure that any cost-benefit analysis is not solely driven by profit, but is grounded in a thorough understanding of regulatory obligations and ethical conduct. The correct approach involves prioritizing regulatory compliance and consumer protection above immediate financial gains. This aligns with the fundamental principles of financial regulation, which aim to maintain market integrity and safeguard investors. Specifically, within the context of the Lufax hiring assessment tests, implied jurisdiction, likely China, given Lufax's origin, but strictly adhering to the exam's stated framework without external assumptions. This means adhering to all relevant laws and guidelines governing financial product development, marketing, and sales. This includes ensuring that the product is suitable for the target market, that all risks are clearly disclosed, and that Lufax has robust internal controls to prevent mis-selling or other regulatory breaches. The ethical imperative is to act in the best interests of the client and the market. An incorrect approach that focuses solely on maximizing short-term profits without adequate consideration for regulatory implications would be professionally unacceptable. This could lead to significant fines, reputational damage, and even legal action. For instance, launching a product without a comprehensive risk assessment or without ensuring clear and understandable disclosures to consumers would violate principles of consumer protection and market conduct, which are central to financial regulation. Another incorrect approach might be to interpret regulatory guidelines in the most lenient way possible to facilitate a quicker launch, thereby increasing the risk of non-compliance. This demonstrates a disregard for the spirit of the law, not just the letter, and can be seen as an ethical failing. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the applicable regulatory landscape. This should be followed by a thorough risk assessment that explicitly considers regulatory compliance. Any proposed product or strategy should then be evaluated against these regulatory requirements and ethical standards. If there is any doubt about compliance, seeking legal and compliance counsel is paramount. The ultimate decision should be one that demonstrably upholds regulatory integrity and protects stakeholders, even if it means foregoing immediate profit opportunities. Question 8. The investigation demonstrates that Lufax is considering expanding its digital financial services into a new international market. While Lufax's current operations are fully compliant with the regulatory framework of its home jurisdiction, the company has not yet conducted a detailed analysis of the specific financial services laws, licensing requirements, and consumer protection regulations in the target country. Which of the following approaches best aligns with professional, ethical, and regulatory obligations for Lufax in this expansion scenario? Option A. Immediately cease all expansion plans until a comprehensive due diligence process, including consultation with local legal and compliance experts in the target jurisdiction, is completed to ensure full adherence to all applicable regulations. Option B. Initiate the expansion by launching a pilot program in the target market and then gather feedback on regulatory compliance challenges to address them post-launch. Option C. Rely on general knowledge of international financial regulations and best practices to guide the expansion, without specific in-depth research into the target country's unique legal landscape. Option D. Proceed with the expansion, assuming that Lufax's existing compliance framework is broadly applicable and will suffice, while making minor adjustments as issues arise. Correct answer is D. Proceed with the expansion, assuming that Lufax's existing compliance framework is broadly applicable and will suffice, while making minor adjustments as issues arise. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to expand its market reach and the stringent regulatory requirements designed to protect investors and market integrity. Lufax, as a financial services provider, operates within a highly regulated environment where compliance is paramount. The challenge lies in navigating the complexities of cross-border financial regulations, ensuring that any expansion is not only commercially viable, but also fully compliant with the laws of both the home jurisdiction and the target market. Misinterpreting or disregarding these regulations can lead to severe penalties, reputational damage, and operational disruption. Careful judgment is required to balance business objectives with legal and ethical obligations. The correct approach involves a thorough and proactive assessment of the regulatory landscape in the target jurisdiction. This means engaging qualified local legal counsel and compliance experts to understand all applicable laws, licensing requirements, consumer protection rules, and data privacy regulations. It requires Lufax to adapt its business model, products, and services to meet these specific requirements before launching operations. This approach is correct because it prioritizes regulatory compliance and investor protection, which are fundamental ethical and legal duties for financial institutions. Adhering to the specific laws of the target market demonstrates respect for the sovereignty of that jurisdiction and ensures that Lufax operates with the necessary authorizations and safeguards in place, thereby mitigating risks and building trust. An incorrect approach would be to assume that the regulatory framework of Lufax's home jurisdiction is sufficient for the new market. This is a failure because financial regulations are jurisdiction-specific and designed to address local market conditions, risks, and consumer protection needs. Operating under the assumption of extraterritorial applicability of home regulations is a direct violation of the target country's laws and can result in immediate legal action, fines, and an inability to operate. Another incorrect approach would be to proceed with the expansion based on a superficial understanding of the target market's regulations, perhaps relying on general industry knowledge or informal advice. This is professionally unacceptable, as it demonstrates a lack of due diligence and a disregard for the seriousness of regulatory compliance. It exposes Lufax to significant legal and financial risks, as well as the potential for harming consumers in the new market. Such an approach prioritizes speed and cost saving over fundamental legal and ethical responsibilities. A professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying all potential regulatory hurdles in the target market. Subsequently, Lufax should consult with experts to understand the implications of these regulations on its business operations. A detailed compliance plan, tailored to the specific requirements of the new jurisdiction, must then be developed and implemented. This plan should include ongoing monitoring and adaptation to any changes in the regulatory environment. Prioritizing a comprehensive understanding and adherence to local laws, even if it means a slower market entry, is the cornerstone of responsible and sustainable international expansion for financial institutions. Question 9. The analysis reveals that a client of Lufax, who has limited investment experience and a low risk tolerance, has specifically requested to invest a significant portion of their savings into a highly speculative, illiquid asset. The Lufax representative is aware that this asset is not aligned with the client's stated financial goals and risk profile, as per the guidelines of the Lufax hiring assessment test. Which of the following approaches best adheres to the regulatory framework and ethical obligations of Lufax? Option A. Proceed with the investment as requested by the client, assuming the client is fully aware of the risks and has the ultimate authority over their investment decisions. Option B. Decline the client's request without further explanation, citing internal Lufax policy that prohibits such investments for clients with low risk tolerance. Option C. Advise the client to seek independent financial advice before proceeding with the investment, without offering any specific Lufax-approved alternatives. Option D. Explain to the client, in detail, why the requested investment is unsuitable based on their profile and the regulatory guidelines, and then propose alternative investments that are aligned with their risk tolerance and financial objectives. The correct answer is A. Proceed with the investment as requested by the client, assuming the client is fully aware of the risks and has the ultimate authority over their investment decisions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the regulatory obligations of Lufax. Lufax, as a regulated entity, must ensure that all investment recommendations and client interactions adhere strictly to the Lufax hiring assessment test's specified regulatory framework, which likely emphasizes client suitability, disclosure, and fiduciary duties. The challenge lies in balancing client autonomy with the responsibility to act in the client's best interest and in compliance with regulations. The correct approach involves prioritizing regulatory compliance and client suitability over a client's potentially uninformed or unsuitable request. This means Lufax representatives must conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments. If the requested product is deemed unsuitable based on this assessment and the regulatory framework, the representative must explain why, in clear terms, and offer suitable alternatives. This aligns with the core principles of client protection and responsible financial advice, mandated by regulatory bodies governing financial institutions like Lufax. The regulatory framework for the Lufax hiring assessment test likely mandates that Lufax acts in the best interests of its clients, which includes ensuring that investments are appropriate for their circumstances. An incorrect approach would be to blindly follow the client's request without due diligence. This failure to assess suitability and provide appropriate advice constitutes a breach of regulatory requirements and ethical standards. It exposes both the client and Lufax to significant risks, including potential financial losses for the client and regulatory penalties, reputational damage, and legal liabilities for Lufax. Another incorrect approach would be to dismiss the client's request outright without offering any suitable alternatives or explanation. This demonstrates a lack of client service and a failure to fulfill the advisory role, potentially alienating the client and missing an opportunity to guide them towards appropriate financial solutions within the regulatory bounds. Professionals should adopt a decision-making framework that begins with understanding the client's needs and objectives, followed by a rigorous assessment of their suitability for any proposed product or service, strictly within the confines of the applicable regulatory framework. Transparency and clear communication are paramount. If a request cannot be met, the reasons must be explained and suitable alternatives offered. This ensures that client interests are protected, regulatory obligations are met, and Lufax maintains its integrity and reputation. Question 10. The performance metrics show a significant increase in new customer acquisition for Lufax's wealth management products, alongside a slight dip in the average customer complaint resolution time. Which approach best reflects a responsible and compliant response to this data, considering the regulatory framework governing financial institutions in China? Option A. Immediately halt all new customer onboarding until the complaint resolution time issue is fully resolved, to avoid any potential regulatory scrutiny. Option B. Accept the performance metrics at face value, assuming the increased acquisition indicates successful product offerings and the reduced resolution time is an efficiency gain. Option C. Conduct a detailed review of the customer onboarding process to ensure compliance with Lufax's internal Know Your Customer (KIC) policies and relevant Chinese financial regulations, while also investigating the reasons for the reduced complaint resolution time to ensure customer satisfaction is not being compromised. Option D. Focus on further incentivizing sales teams to accelerate new customer acquisition, as the dip in complaint resolution time is likely a temporary operational fluctuation. The correct answer is C. Conduct a detailed review of the customer onboarding process to ensure compliance with Lufax's internal Know Your Customer (KIC) policies and relevant Chinese financial regulations, while also investigating the reasons for the reduced complaint resolution time to ensure customer satisfaction is not being compromised. Explanation: this scenario presents a professional challenge because it requires an individual to interpret performance data within the specific regulatory context of Lufax's operations, which are governed by Chinese financial regulations. The core difficulty lies in distinguishing between legitimate business performance indicators and potential red flags that could signal noncompliance or unethical practices, necessitating a nuanced understanding of Lufax's internal policies and external regulatory environment. Careful judgment is required to avoid misinterpreting data, which could lead to incorrect conclusions about business health or employee conduct. The correct approach involves a comprehensive review of Lufax's internal compliance policies and relevant Chinese financial regulations concerning customer onboarding and risk assessment. This approach is professionally sound because it directly addresses the need to evaluate performance metrics against established legal and ethical standards. Specifically, it aligns with the principles of regulatory compliance and responsible business conduct expected of financial institutions operating under Chinese law. By cross-referencing performance data with these frameworks, one can accurately identify any deviations that might indicate breaches of regulations, such as inadequate Know Your Customer (KIC) procedures or misrepresentation of financial products, thereby ensuring Lufax operates within legal boundaries and maintains customer trust. An incorrect approach that focuses solely on achieving aggressive sales targets without considering the underlying compliance implications is professionally unacceptable. This failure stems from prioritizing business growth over regulatory adherence, which can lead to significant legal penalties, reputational damage, and harm to customers. Such an approach violates principles of responsible financial conduct and could contravene specific Chinese regulations designed to protect investors and maintain market integrity. Another incorrect approach that involves overlooking discrepancies in customer data due to time pressure demonstrates a lack of diligence and a disregard for compliance procedures. This can result in onboarding unsuitable clients or facilitating fraudulent activities, directly contravening anti-money laundering (AML) and customer due diligence requirements mandated by Chinese financial authorities. A third incorrect approach that assumes all performance metrics are inherently positive without independent verification ignores the potential for data manipulation or misinterpretation. This passive stance fails to uphold the professional duty of scrutiny and can mask underlying issues that require immediate attention and corrective action, thereby undermining the effectiveness of internal controls and regulatory oversight. Professionals should adopt a decision-making framework that begins with a thorough understanding of the applicable regulatory landscape and Lufax's internal compliance policies. This should be followed by a critical evaluation of performance metrics, actively seeking to identify any potential deviations from established standards. When discrepancies arise, the professional should initiate a deeper investigation, consulting with compliance officers or legal counsel as necessary, rather than making assumptions or overlooking issues. This proactive and diligent approach ensures that business objectives are pursued ethically and in full compliance with all relevant laws and guidelines. Question 11. To address the challenge of ensuring strict adherence to the Lufax hiring assessment test regulatory framework, a candidate is presented with a scenario involving client onboarding. The candidate must determine the correct procedure based solely on the provided Lufax hiring assessment test guidelines. Which of the following approaches best demonstrates the required level of jurisdictional compliance and professional integrity? Option A. Strictly referencing and applying only the specific laws, regulations, and guidelines explicitly provided within the Lufax hiring assessment test materials for the relevant jurisdiction. Option B. Researching and applying onboarding regulations from a neighboring country that has a similar financial market structure, believing it offers a more robust framework. Option C. Prioritizing the speed of client onboarding by using a simplified, commonly accepted checklist without cross-referencing the specific Lufax hiring assessment test guidelines. Option D. Applying general financial services onboarding best practices commonly used in the industry, assuming they align with Lufax's internal policies. The correct answer is D. Applying general financial services onboarding best practices commonly used in the industry, assuming they align with Lufax's internal policies. Explanation. This scenario presents a professional challenge because Lufax, as a financial services provider, operates under stringent regulatory oversight. Employees are expected to uphold the highest ethical standards and adhere strictly to all applicable laws and guidelines. The core of the challenge lies in balancing the company's commercial interests with its regulatory obligations and ethical responsibilities towards clients and the market. Misinterpreting or disregarding these requirements can lead to severe consequences, including regulatory sanctions, reputational damage, and loss of client trust. Careful judgment is required to navigate situations where potential conflicts or ambiguities arise, ensuring that all actions align with the established framework. The correct approach involves a thorough understanding and application of the Lufax hiring assessment test's specific regulatory framework, laws, and guidelines. This means prioritizing compliance with the stipulated jurisdiction's rules above all else. Professionals must actively seek to identify and apply the precise regulations relevant to the situation, avoiding any assumptions or reliance on external or generic knowledge. This approach is correct because it directly addresses the absolute priority requirement of the assessment, which is to demonstrate strict adherence to the specified regulatory environment. It ensures that decision-making is grounded in the authoritative sources provided for the exam, reflecting a commitment to professional integrity and regulatory discipline. An incorrect approach that relies on general industry best practices without verifying their alignment with the Lufax hiring assessment test's specific jurisdiction would be professionally unacceptable. This failure stems from a disregard for the explicit instruction to adhere only to the specified framework. Such an approach risks applying regulations that are either irrelevant or contradictory, leading to noncompliance. Another incorrect approach would be to incorporate knowledge or regulations from other jurisdictions, even if they seem similar or more comprehensive. This directly violates the strict jurisdiction compliance requirement. It demonstrates a lack of attention to detail and an inability to follow precise instructions, which are critical attributes for professionals in regulated industries. A third incorrect approach might be to prioritize speed or convenience over accuracy in regulatory interpretation. This could involve making assumptions or using shortcuts when identifying applicable rules. Such an approach is ethically flawed as it compromises the integrity of the decision-making process and increases the risk of regulatory breaches. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify the core issue and the relevant regulatory context as defined by the Lufax hiring assessment test's specified jurisdiction. 2. Consult the precise laws, regulations, and guidelines provided for the assessment. 3. Analyze the situation against these specific requirements, ensuring no external or generic information is inadvertently introduced. 4. Document the reasoning and the specific regulatory basis for the decision. 5. Seek clarification from appropriate internal resources if any ambiguity persists, always within the confines of the assessment's jurisdiction. Question 12. The review process indicates that a candidate for a role at Lufax has demonstrated a strong understanding of general financial services compliance principles. However, when presented with a scenario involving client data handling during the Lufax hiring assessment test, candidate's response appears to draw heavily on common international data privacy standards rather than the specific regulatory framework explicitly provided for this assessment. Which of the following approaches best reflects the required adherence to the Lufax hiring assessment test's jurisdictional requirements? Option A. Focusing on the most efficient and client-friendly approach, assuming that such practices are implicitly compliant with any regulatory framework. Option B. Prioritizing the application of the specific regulatory framework and guidelines provided solely for the Lufax hiring assessment test, ensuring all actions and decisions align strictly with its defined parameters. Option C. Incorporating relevant regulations from other financial jurisdictions that appear to offer stronger protections, believing this demonstrates a superior level of compliance awareness. Option D. Applying a blend of general financial services, compliance principles, and common international data privacy standards, assuming these are universally accepted and therefore applicable. Correct answer is B. Prioritizing the application of the specific regulatory framework and guidelines provided solely for the Lufax hiring assessment test, ensuring all actions and decisions align strictly with its defined parameters. Explanation. This scenario presents a professional challenge because Lufax, as a financial services provider, operates under stringent regulatory oversight. The core of the challenge lies in balancing the need for efficient internal operations and client service with the absolute requirement to adhere to the specific regulatory framework governing Lufax's activities. Misinterpreting or misapplying these regulations can lead to significant compliance breaches, reputational damage, and potential penalties. Careful judgment is required to ensure that any operational decision, especially one involving client data or interactions, is fully compliant. The correct approach involves a thorough understanding and direct application of the Lufax hiring assessment test specified regulatory framework. This means prioritizing adherence to the precise rules and guidelines outlined for the assessment itself, rather than relying on general industry best practices or assumptions. This approach is correct because it directly addresses the exam's explicit instruction to operate solely within its defined jurisdiction. Professional ethics and regulatory compliance demand that individuals undertaking assessments or operating within a regulated environment strictly follow the prescribed rules of engagement. This ensures fairness, integrity, and the validity of the assessment process, and by extension, the competence of the candidate. An incorrect approach that relies on general financial industry best practices without specific reference to the Lufax hiring assessment test's framework fails because it deviates from the mandated jurisdiction. This is a regulatory failure as it ignores the explicit constraints of the assessment. Another incorrect approach that attempts to incorporate principles from other jurisdictions, even if seemingly similar, is also a critical failure. This violates the absolute priority requirement and demonstrates a lack of understanding of the assessment's specific scope and limitations, leading to a non-compliant response. A third incorrect approach that prioritizes speed or perceived efficiency over strict regulatory adherence is fundamentally flawed. This demonstrates a disregard for compliance, which is paramount in regulated industries and within the context of a hiring assessment designed to evaluate such understanding. The professional decision-making process for similar situations should begin with a clear identification of the governing regulatory framework. This involves meticulously reviewing all provided documentation, guidelines, and legal statutes relevant to the specific context, in this case, the Lufax hiring assessment test. Next, one must analyze the specific question or scenario through the lens of this framework, identifying any potential conflicts or ambiguities. The decision should then be made by selecting the option that most directly and accurately reflects the requirements of the specified jurisdiction, prioritizing compliance above all else. If there is any doubt, seeking clarification from the assessment administrators or relevant compliance officers would be the next professional step. Question 13. What factors determine the appropriate standard for client data confidentiality and protection when Lufax employees engage in cross-border business activities involving clients located in different regulatory environments? Option A. The least restrictive data protection regulations across all involved jurisdictions. Option B. The data protection regulations of Lufax's primary operating jurisdiction, regardless of the client's location. Option C. The most stringent data protection and confidentiality regulations applicable to the client's data, considering all relevant jurisdictions. Option D. An assumption that all jurisdictions have similar data protection standards. The correct answer is C. The most stringent data protection and confidentiality regulations applicable to the client's data, considering all relevant jurisdictions. Explanation. This scenario presents a professional challenge for Lufax employees regarding the appropriate handling of client information when engaging in cross-border business activities. The core difficulty lies in navigating potentially differing regulatory requirements and ethical standards between jurisdictions, ensuring client confidentiality and data protection are maintained at the highest applicable standard. Careful judgment is required to avoid inadvertent breaches of privacy or non-compliance with relevant laws. The correct approach involves prioritizing the most stringent data protection and confidentiality regulations applicable to the client's data, regardless of Lufax's primary operating jurisdiction. This is because clients entrust Lufax with sensitive information, and the ethical obligation to protect this data supersedes any desire to adopt a less rigorous standard simply because it might be permissible in another location. Adhering to the strictest applicable standard ensures compliance with principles of data privacy and client trust, which are fundamental to financial services. This aligns with general principles of data protection and ethical conduct expected of financial institutions, aiming to safeguard client interests and maintain the integrity of Lufax's operations. An incorrect approach would be to apply only the data protection regulations of Lufax's primary operating jurisdiction without considering the client's location or the origin of the data. This fails to acknowledge the potential for stricter regulations in the client's jurisdiction or where the data was generated, leading to a risk of non-compliance and a breach of client confidentiality. Another incorrect approach is to assume that all jurisdictions have similar data protection standards, which is a dangerous oversimplification and ignores the diverse regulatory landscape. This can result in overlooking critical requirements and exposing Lufax and its clients to legal and reputational risks. Finally, adopting a lowest common denominator approach, where the least restrictive regulation across all involved jurisdictions is applied, is ethically unsound and legally perilous, as it prioritizes operational ease over client protection. Professionals should employ a decision-making framework that begins with identifying all relevant jurisdictions and their respective data protection and confidentiality laws. They must then conduct a comparative analysis to determine the most stringent requirements. The principle of privacy by design should guide their actions, ensuring that data protection is embedded into processes from the outset. When in doubt, seeking guidance from Lufax's legal and compliance departments is crucial to ensure adherence to all applicable regulations and ethical standards. Question 14. Governance review demonstrates that Lufax employees are expected to maintain the highest standards of integrity and avoid conflicts of interest. Considering the potential for personal investments to create such conflicts, which of the following approaches best aligns with Lufax's commitment to regulatory compliance and ethical conduct regarding employee personal financial dealings? Option A. Disclose personal investments but continue with trading activities as usual, assuming Lufax's internal policies are sufficiently robust to manage any issues. Option B. Proactively disclose all personal investments that could potentially create a conflict of interest to the compliance department for review and guidance. Option C. Only disclose personal investments when specifically prompted by a manager or the compliance department. Option D. Do not disclose personal investments unless they directly involve Lufax's publicly traded securities, as other investments are unlikely to pose a conflict. The correct answer is B. Proactively disclose all personal investments that could potentially create a conflict of interest to the compliance department for review and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge for Lufax employees by requiring them to navigate potential conflicts of interest arising from personal investments that could impact their professional duties. The challenge lies in identifying and managing these conflicts in a way that upholds Lufax's integrity and complies with regulatory expectations, particularly concerning insider information and fair market practices. Careful judgment is required to distinguish between permissible personal financial activities and those that could lead to reputational damage or regulatory breaches. Correct approach analysis. The correct approach involves Lufax employees proactively disclosing any personal investments that could present a conflict of interest to their compliance department. This aligns with the principles of good corporate governance and regulatory compliance, as it allows Lufax to monitor and manage potential conflicts effectively. Specifically, this approach adheres to the spirit and letter of regulations that mandate transparency and the prevention of insider trading and market manipulation. By disclosing, employees enable Lufax to implement appropriate controls, such as restricting trading activity or recusing individuals from specific decisions, thereby safeguarding the company's reputation and ensuring fair market conduct. Incorrect approach is analysis, an approach where employees do not disclose personal investments, assuming they are not material or do not directly involve Lufax's securities, is professionally unacceptable. This failure to disclose creates a blind spot for Lufax's compliance function, increasing the risk of inadvertent insider trading or the appearance of impropriety. It violates the ethical obligation of transparency and potentially breaches regulatory requirements for conflict of interest management. Another incorrect approach is to disclose only when explicitly asked by a supervisor or compliance officer. This reactive stance is insufficient. Regulations and ethical guidelines emphasize proactive identification and disclosure of potential conflicts. Waiting to be asked implies a lack of personal responsibility in managing one's own ethical obligations and can lead to situations where conflicts have already materialized, causing harm before they are addressed. Finally, an approach where employees disclose but continue to engage in trading activities without seeking guidance or adhering to any restrictions imposed by Lufax is also professionally unacceptable. Disclosure without subsequent adherence to management protocols negates the purpose of the disclosure. It demonstrates a disregard for Lufax's internal policies and the regulatory framework designed to prevent conflicts of interest and market abuse. Professional reasoning. Professionals at Lufax should adopt a proactive and transparent approach to managing personal investments. This involves understanding Lufax's internal policies on personal trading and conflicts of interest, which are designed to align with regulatory expectations. When in doubt about whether an investment could constitute a conflict, the default professional action is to err on the side of caution and disclose it to the compliance department. This allows for a formal assessment and guidance, ensuring that personal financial activities do not compromise professional integrity or regulatory compliance. The decision-making process should prioritize the company's ethical standards and regulatory obligations over personal convenience or perceived minor risks. Question 15. Risk assessment procedures indicate that Lufax is planning to implement a new client onboarding system that will process a significant volume of personal and financial data. Which of the following actions best ensures compliance with data protection regulations and ethical data handling practices prior to the system's launch? Option A. Conduct a comprehensive data privacy impact assessment (DPIA) to identify and mitigate potential risks to personal data before system implementation. Option B. Implement the new system and then conduct a review of data privacy compliance after the system has been in operation for a period. Option C. Assume that Lufax's existing, broad data protection policies will adequately cover the data processing activities of the new system. Option D. Obtain a general assurance from the IT department that the new system's security protocols meet industry standards. The correct answer is A. Conduct a comprehensive data privacy impact assessment (DPIA) to identify and mitigate potential risks to personal data before system implementation. Explanation. This scenario presents a professional challenge because Lufax, as a financial services provider, operates under stringent regulatory scrutiny. Core difficulty lies in balancing the need for efficient data processing and client onboarding with the absolute imperative of adhering to data privacy and security regulations. Misinterpreting or inadequately applying these regulations can lead to severe consequences, including regulatory fines, reputational damage, and loss of client trust. The professional must exercise careful judgment to ensure compliance without unduly hindering business operations. The correct approach involves a proactive and comprehensive data privacy impact assessment, DPIA, that is conducted before the new client onboarding system is implemented. This assessment must specifically identify and evaluate the risks associated with processing personal data within the proposed system, considering the types of data, the purpose of processing, and the potential impact on individuals. The regulatory justification for this approach stems from the principles of data protection by design and by default, which are fundamental to many data privacy frameworks. By conducting a DPIA upfront, Lufax can identify potential compliance gaps and implement necessary safeguards, such as enhanced security measures, data minimization techniques, or revised consent mechanisms, prior to deployment. This aligns with the ethical obligation to protect client data and the regulatory requirement to demonstrate accountability for data processing activities. An incorrect approach would be to proceed with the implementation of the new system and then conduct a post-implementation review of data privacy compliance. This approach fails to uphold the principles of data protection by design and by default. The regulatory failure lies in not proactively identifying and mitigating risks before data processing begins, potentially exposing Lufax and its clients to breaches or unauthorized access. Ethically, it demonstrates a reactive rather than a responsible stance towards data protection. Another incorrect approach is to rely solely on the IT department's assurance that the system is secure, without a dedicated data privacy assessment. While IT security is crucial, it does not encompass the full scope of data privacy regulations, which include considerations like lawful basis for processing, data subject rights, and data retention policies. The regulatory failure here is the omission of a specialized privacy risk assessment, which is often a mandatory requirement for systems processing personal data. This approach also overlooks the ethical duty to ensure that data processing is not only secure, but also lawful and fair. A further incorrect approach would be to assume that existing general data protection policies are sufficient for the new system without a specific assessment. New systems often introduce novel data processing activities or handle data in new ways, which may fall outside the scope of existing, generalized policies. The regulatory failure is the failure to conduct a specific assessment for the new system, which could lead to non-compliance with specific provisions of data privacy laws that are triggered by the new system's functionalities. Ethically, this demonstrates a lack of due diligence in safeguarding client data within the context of evolving technological capabilities. The professional decision-making process for similar situations should involve a structured risk management framework. This framework should prioritize regulatory compliance and ethical considerations. When introducing new systems or processes that involve personal data, the first step should always be to identify relevant data protection regulations. Subsequently, a comprehensive risk assessment, including a DPIA where applicable, should be conducted before implementation. This assessment should involve relevant stakeholders, including legal, compliance, IT, and business units. Based on the identified risks, appropriate mitigation strategies should be developed and implemented. Finally, ongoing monitoring and periodic reviews are essential to ensure continued compliance and adapt to any changes in regulations or business practices. Question 16. Quality control measures reveal that Lufax is utilizing customer transaction data to identify service improvement opportunities. Which of the following approaches best ensures compliance with data privacy regulation while enabling effective quality control? Option A. Implementing advanced anonymization and aggregation techniques on the transaction data before it is used for analysis. Option B. Using raw, identifiable customer transaction data for analysis, with a strict internal policy prohibiting its sharing outside the quality control team. Option C. Conducting the quality control analysis on identifiable data and then anonymizing the findings after the analysis is complete. Option D. relying on Lufax's existing general data handling policies to govern the use of customer transaction data for quality control. Correct answer is A. Implementing advanced anonymization and aggregation techniques on the transaction data before it is used for analysis. Explanation. This scenario presents a professional challenge because it requires Lufax to balance the need for efficient data processing with the stringent regulatory obligations concerning customer data privacy and security. The core tension lies in ensuring that, while data is utilized for internal improvement, it remains protected from unauthorized access and complies with all applicable regulations. Careful judgment is required to implement measures that are both effective and compliant. The correct approach involves implementing robust anonymization and aggregation techniques before any data is used for quality control analysis. This method is correct because it directly addresses the regulatory requirement to protect customer personal information. By anonymizing and aggregating data, Lufax ensures that individual customer identities cannot be discerned, thereby minimizing privacy risks and adhering to data protection principles. This proactive measure aligns with the spirit and letter of regulations designed to safeguard sensitive customer data. An incorrect approach would be to use raw, identifiable customer data for quality control analysis without adequate safeguards. This fails to meet regulatory obligations by exposing personal information to potential breaches or misuse, even within the company. Another incorrect approach would be to rely solely on internal policies that are not demonstrably aligned with specific regulatory requirements for data anonymization or aggregation. This creates a compliance gap, as internal policies must be grounded in and reflect external legal mandates. Finally, an approach that delays or omits the anonymization process, even for a short period, introduces unnecessary risk and potential noncompliance with data protection laws. Professionals should employ a decision-making framework that prioritizes regulatory compliance from the outset. This involves understanding the specific data protection laws applicable to Lufax's operations, identifying the types of data being handled, and then designing processes that inherently embed privacy and security. A risk-based approach, where potential data privacy risks are assessed and mitigated through appropriate technical and organizational measures like anonymization and aggregation, is crucial. Regular review and updates of these processes in light of evolving regulations and best practices are also essential. Question 17. The assessment process reveals that a Lufax employee, responsible for client onboarding, is unsure about the precise documentation required for a specific type of international client, as Lufax's internal policy document appears to have conflicting clauses. The employee has a colleague who has handled similar clients before and is considering proceeding based on their colleague's informal guidance to avoid delaying the onboarding process. What is the most appropriate course of action for the Lufax employee in this situation? Option A. Proceed with the onboarding using the informal guidance from the colleague, assuming it reflects current practice. Option B. Immediately consult Lufax's compliance department for clarification on the policy and regulatory requirements before proceeding with the onboarding. Option C. Interpret the conflicting clauses in the policy document based on personal judgment and proceed with the onboarding. Option D. Delay the onboarding indefinitely until the policy document is officially updated to remove the ambiguity. The correct answer is B. Immediately consult Lufax's compliance department for clarification on the policy and regulatory requirements before proceeding with the onboarding. Explanation. This scenario presents a professional challenge because it requires navigating the complex intersection of internal company policies, regulatory expectations, and ethical conduct within the financial services industry, specifically as it pertains to Lufax's operations. The core difficulty lies in ensuring that all actions taken by employees, particularly in client-facing roles or those handling sensitive information, strictly adhere to the established regulatory framework governing Lufax's business. Misinterpreting or disregarding these requirements can lead to significant compliance breaches, reputational damage, and potential legal repercussions. Careful judgment is paramount to avoid even the appearance of impropriety or noncompliance. The correct approach involves proactively seeking clarification from the designated compliance department when any ambiguity arises regarding Lufax's internal policies or relevant regulations. This demonstrates a commitment to regulatory adherence and ethical responsibility. By engaging with the compliance team, an employee ensures that their understanding and subsequent actions are aligned with Lufax's official stance and the governing regulatory framework. This proactive measure is crucial for maintaining a compliant operational environment and safeguarding both the individual and the company. This aligns with the principle of know your obligations and the duty to act with integrity, which are fundamental tenets of financial services regulation and professional conduct expected by bodies like CISI, if applicable to the exam's jurisdiction. An incorrect approach of proceeding based on personal interpretation or informal advice from colleagues is professionally unacceptable. This bypasses the established channels for regulatory guidance and can lead to unintentional breaches of Lufax's policies or applicable laws. Relying on personal interpretation ignores the nuanced nature of financial regulations, which often require expert understanding. Seeking informal advice from colleagues, while seemingly helpful, lacks the authority and accuracy of official guidance from the compliance department and can perpetuate misunderstandings or incorrect practices. This failure to consult official channels represents a disregard for the established compliance framework and a potential violation of the duty of care owed to clients and the company. Another incorrect approach is to assume that a lack of explicit prohibition means an action is permissible. Regulatory frameworks often operate on the principle of, if it's not explicitly allowed and governed, it may be implicitly restricted or require specific approval. This passive approach to compliance can lead to overlooking potential risks or regulatory gaps. Professionals are expected to be diligent and to actively ensure their conduct aligns with the spirit and letter of the regulations, not just to avoid explicitly forbidden actions. The professional decision-making process for similar situations should involve a clear hierarchy of information seeking. When faced with uncertainty regarding policies or regulations, the first step should always be to consult official Lufax documentation and the compliance department. If further clarification is needed, formal channels for seeking advice should be utilized. This systematic approach ensures that decisions are informed, compliant, and ethically sound, minimizing the risk of regulatory breaches and upholding professional standards. Question 18. Quality control measures reveal that Lufax's internal review process for customer service interactions involves analysts accessing raw, unredacted customer data to identify areas for improvement. Which of the following approaches best ensures regulatory compliance and protects customer privacy? Option A. Implement a mandatory data anonymization or pseudonymization process for all customer interaction data before it is accessed by quality control analysts. Option B. Update Lufax's internal policies to emphasize the importance of data privacy without altering the current data access procedures for quality control. Option C. Continue with the current practice of accessing raw customer data, relying on the analyst's professional discretion to handle sensitive information appropriately. Option D. Limit the number of analysts who can access raw customer data, assuming that fewer individuals mean lower risk. The correct answer is A. Implement a mandatory data anonymization or pseudonymization process for all customer interaction data before it is accessed by quality control analysts. Explanation. This scenario presents a professional challenge because it requires Lufax to balance the need for efficient data processing with the stringent requirements of regulatory compliance, specifically concerning data privacy and security. The core tension lies in ensuring that while data is utilized for quality control, it remains protected and handled in accordance with applicable laws. Careful judgment is required to identify and implement measures that satisfy both operational efficiency and regulatory mandates without compromising customer trust or incurring legal penalties. The correct approach involves implementing robust data anonymization and pseudonymization techniques before the data is accessed by the quality control team. This method ensures that sensitive personal information is either removed or rendered unidentifiable, thereby minimizing the risk of data breaches and unauthorized access. This aligns with the principles of data minimization and purpose limitation, which are fundamental to data protection regulations. By processing anonymized or pseudonymized data, Lufax can conduct its quality control checks effectively while adhering to its legal obligations to protect customer privacy. An approach that involves direct access to raw, identifiable customer data for quality control purposes is ethically and regulatorily unsound. This failure stems from a direct violation of data privacy principles, potentially contravening regulations that mandate secure handling and limited access to personal information. Such an approach increases the risk of data exposure and misuse, leading to severe reputational damage and legal repercussions. Another incorrect approach, which is to rely solely on internal policies without verifying their alignment with current regulatory standards, is also professionally unacceptable. While internal policies are important, they must be grounded in and regularly updated to reflect the latest legal and regulatory requirements. Failure to do so means that the company might be operating under outdated or insufficient compliance measures, leaving it vulnerable to regulatory scrutiny and enforcement actions. The professional decision-making process for similar situations should involve a proactive risk assessment framework. This framework should prioritize understanding the specific data protection laws applicable to Lufax's operations. Before any data processing activity, especially for quality control, a thorough assessment of potential privacy risks should be conducted. This assessment should then inform the selection of appropriate data handling techniques, such as anonymization or pseudonymization, and the implementation of strong security controls. Regular training for staff involved in data handling and periodic audits of compliance procedures are also crucial components of this framework to ensure ongoing adherence to regulatory standards. Question 19. Quality control measures reveal that a new client application for Lufax's investment platform has been processed with only a cursory review of the submitted identification documents and a brief online search for adverse media, despite the client's stated occupation being in a high-risk industry. The onboarding team expedited the process to meet their monthly target for new account openings. Which of the following actions, if taken by the compliance department upon discovering this, best upholds regulatory requirements and professional ethics? Option A. Request the client to resubmit documents, but proceed with account activation while awaiting the new submission to avoid further delays. Option B. Immediately escalate the client file for enhanced due diligence and a comprehensive review of the onboarding process to identify systemic weaknesses. Option C. Accept the onboarding as completed, assuming the client's occupation was a minor oversight and the online search was sufficient for risk assessment. Option D. Advise the onboarding team to be more diligent in the future but allow the account to remain active, focusing on future applications. The correct answer is B. Immediately escalate the client file for enhanced due diligence and a comprehensive review of the onboarding process to identify systemic weaknesses. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient client onboarding with the stringent regulatory obligations designed to prevent financial crime. The pressure to meet performance targets can create a temptation to bypass or expedite due diligence processes, which is a significant compliance risk. Careful judgment is required to ensure that speed does not compromise the integrity of the Know Your Customer (KIC) and anti-money laundering (AML) procedures mandated by the Lufax hiring assessment tests implied regulatory framework, which we will assume aligns with typical financial services regulations in a major jurisdiction like Singapore. Given Lufax's operational context, the correct approach involves a thorough and documented review of the client's provided documentation, cross-referencing it with available internal and external data sources to verify identity and assess risk. This approach upholds the principle of robust customer due diligence, a cornerstone of AML/CFT, combating the financing of terrorism regulations. Specifically, it aligns with the requirements for customer identification and verification, risk assessment, and ongoing monitoring, ensuring that Lufax fulfills its legal and ethical obligations to prevent its services from being used for illicit purposes. This thoroughness, even if it delays onboarding, is essential for regulatory compliance and maintaining the firm's reputation. An incorrect approach that involves accepting the client's self-declaration without independent verification fails to meet the minimum standards for customer due diligence. This bypasses the critical step of verifying the accuracy and authenticity of the information provided, leaving Lufax exposed to the risk of onboarding individuals involved in financial crime. This directly contravenes regulatory expectations for risk-based approaches to customer due diligence. Another incorrect approach, which is to proceed with onboarding based on a superficial review of documents and a quick online search, is also professionally unacceptable. While it attempts some level of verification, it is insufficient to identify potential red flags or to adequately assess the client's risk profile. This superficiality can lead to the onboarding of high-risk clients without appropriate enhanced due diligence, thereby failing to comply with the risk-based principles embedded in AML/CFT regulations. Finally, an approach that prioritizes speed over compliance by expediting the process without proper documentation or risk assessment is a direct violation of regulatory requirements. This demonstrates a disregard for the firm's compliance obligations and can result in severe penalties, including fines and reputational damage. The professional decision-making process for similar situations should involve 1. Understanding the regulatory requirements for customer due diligence and risk assessment. 2. Evaluating the client's information against these requirements, identifying any gaps or inconsistencies. 3. Applying a risk-based approach, escalating for further scrutiny or enhanced due diligence where necessary. 4. Documenting all steps taken and decisions made. 5. Prioritizing compliance and risk mitigation over speed, especially when dealing with potentially high-risk clients or situations. Question 20. Compliance review shows that a Lufax client has requested a specific type of investment product that, while potentially profitable, falls outside the standard offerings and may involve a higher risk profile than Lufax typically facilitates for its retail clients. The client has expressed strong confidence in this product and is pressuring the assigned Lufax representative to expedite the process. Option A. Independently research the investment product and its regulatory implications to determine if it can be offered to the client. Option B. Escalate the client's request and the associated concerns to the Lufax Compliance Department for review and guidance. Option C. Directly approve the client's request to proceed with the investment product, assuring the client of Lufax's commitment to meeting their needs. Option D. Inform the client that Lufax cannot accommodate their request and suggest they seek alternative investment avenues. The correct answer is B. Escalate the client's request and the associated concerns to the Lufax Compliance Department for review and guidance. Explanation. This scenario presents a professional challenge because it requires an employee to navigate a potential conflict between a client's request and Lufax's internal policies, which are designed to ensure regulatory compliance and protect both the company and its clients. The employee must exercise sound judgment to uphold ethical standards and adhere to the regulatory framework governing Lufax's operations. The correct approach involves escalating the matter to the compliance department. This is the most appropriate professional response because it acknowledges the potential breach of Lufax's policies and the relevant regulatory requirements. By involving the compliance department, the employee ensures that the situation is reviewed by individuals with the expertise to interpret regulations, assess risk, and determine the appropriate course of action in accordance with Lufax's obligations. This upholds the principle of regulatory adherence and demonstrates a commitment to ethical conduct. An incorrect approach would be to directly fulfill the client's request without further consultation. This fails to recognize the potential for non-compliance with Lufax's internal policies and applicable regulations, exposing both the employee and Lufax to significant risks, including regulatory penalties and reputational damage. Another incorrect approach would be to ignore the client's request and provide no response. This is unprofessional and can damage the client relationship. It also misses an opportunity to address a potential compliance issue proactively. A further incorrect approach would be to attempt to interpret the regulations and make a decision independently without consulting the compliance department. This is risky as it assumes a level of expertise that may not be present, leading to potential misinterpretations of complex regulatory requirements and subsequent noncompliance. Professionals should employ a decision-making framework that prioritizes adherence to company policy and regulatory mandates. When faced with a situation that appears to deviate from established guidelines or raises compliance concerns, the immediate step should be to consult with the designated compliance or legal department. This ensures that all actions are taken within the bounds of the law and company policy, mitigating risk and upholding ethical standards.